For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
Yes, indeed. It is Managing Your Financial Future. Welcome back to the program, the podcast. Johnny Dean, your podcast host, illustrious podcast host. I just threw that adjective in. Why not? Hey, I am the host. I can say that. And my illustrious guest. Are you my guest, Professor Rick Plum, certified financial planner, professional, and accredited wealth management advisor? You're more of a co-host. I don't know why I would say you're a guest. I mean, you're really
guest is a periodic visitor. And I guess I'm not all that periodic.
Nah,
always here.
You're about as regular as things get as far as guest appearances go. So at some point, you have to be made a regular cast member. You know, so I think that's. I think it's fair to say you're the co-host here, but you're the advisory half of all this, and you are needed because we draw on not just your experience but your knowledge and all that stuff, and it really helps, especially in today's. And this is where experience really counts on today's topic. And the overall theme is, if I can use a phrase that I didn't make up, but one that I've taken to heart, and I know you have, lo these many years. The phrase and the topic is, the best way to win is to keep from losing. Now, I guess I could say potentially win, but
the best offense is a good defense. I mean,
in many ways, yeah. Although that's... You could make a case. That was the sports analogy. You could make a case in certain sports where a better offense could potentially beat a better defense. But I don't see how there's no corollary necessarily for investing, financial planning, portfolio management, and all that stuff. The best way to win is to keep from losing. And we've been saying this for a long time. And I was looking at. This is kind of what spurred this thought with me. Jonathan Clements, who is a writer for the Wall Street Journal, a financial writer, and a pretty smart guy, too. I'm sure you know who he is, Rick. He just passed away not too long ago, actually. But he wrote back about 10 years ago or so, he wrote a book called How to Think About Money. And I was kind of reading stuff about his life, and they brought up this book. And this book was a guide on how to focus on making and saving money. That was kind of the big thing. And there was like a 2-word commandment that somebody mentioned in this book, and it was minimize subtractions.
Okay, I can agree with that.
Yeah, minimize subtractions. It wasn't go out and earn the best rate of return. It was minimize subtractions. Now, I think he was, he was referring to things like all-inclusive things, watch fees, manage your taxes, and all that stuff, which is good. But it also talked about withdrawal and don't sell things when they're down. And I thought, oh man, even a guy like that is understanding exactly what it is that we're talking about. And one other person that I bring up a lot on this is Morgan Housel. And he said that he's often said minimizing losses is one of the most underrated but most effective ways to build lasting wealth. Those are his words. He had actually said the most important part of every plan is planning on your plan, not going according to plan, which I thought was a wonderful quote in The Psychology of Money. Another one was you don't need tremendous insider skill to succeed. You just need to not screw up. 100% true. And this one we've used on this podcast too. He said in The Psychology of Money, there are a million ways to get wealthy, but there's only one way to stay wealthy, some combination of frugality and paranoia. You guys, you and I have talked about this before. All right. So yeah. What does all this mean? Well, I want to talk with you, Rick, about this whole idea of the best way to win is to keep from losing. So what are some ways to prevent yourself from losing? I want to run down some of these with you, and I know you'll agree with these, but I want to start with the main thing, the thing that I would put at the top, and maybe you would too. One way to keep from losing would be to separate your income needs from your growth assets. To me, the number one way to lose in retirement is to sell stocks during a downturn to pay your bills. What say you?
Well, if you are forced to sell your stocks to pay your bills. That's a problem if you've ever been put in that position. And that's only part of it, though, because hopefully you don't force yourself to sell stocks. And I guess what I'm looking at and trying to formulate in my mind is people sell stocks when they're down, even when they don't need income, because they're afraid of never recovering. And that's so far in history been wrong, unless you're buying, what was it, Enron? Some of the people are like, what? That goes back a few days. But it's a matter of anytime you can avoid selling when it's at a loss because of market conditions. The market is down right now. Not that this stock is a stinker, because an individual stock can be a stinker, and it probably needs to be sold regardless of what the price is at some points. But if all we're doing is going through a market downturn where everything's down because of some news that came out, and you're selling because you have to, that is a problem. For a couple of reasons. One is that you're going to lose money. One is it's going to stress you out. And that it's also going to then move you to want to sell more because you don't want to lose more for the next time, which means you pull even more out of the market and lose out on that as well, because sometimes the markets do turn around and correct. We don't know when that's going to happen. So it has a very big psychological effect on us. When the market's down and we don't have any other source of capital to spend, and we knew that we were going to need to spend the money, that was just a wrong way to do things, but unfortunately people do it. And it's a trickle down, though. Like I said, it's not just that 1 month's worth of income that can never recover. It's the psychological effect that, well, I need to cut back my spending, so I'm going to screw up my retirement life. I'm not going to do the things in retirement that I wanted to do. I'm letting the market dictate my retirement. That's not a good thing. I'm missing out on the return of the money I just sold, and I'm panicking about the rest of it, so I'm even selling more, which hurts even more. So it hits me on all sides. It messes with my feelings towards enjoying my retirement. It messes with my ability to enjoy retirement. It takes away the ability to recover when the markets recover. So putting yourself in a position where you're selling assets that have a negative return recently to meet expected current financial obligations, you're asking for trouble. And it's like I said, it's not just the math, the trouble, and it's a psychological issue, the anxiety. It's everything that goes along with it. And the math is easy. I mean, you lose, 25%, it takes 33% to get back to even. Well, it could be 1,000,000% to get back to even. You haven't got the money there anymore. You sold it. So it doesn't matter what your upside return was. You sold the asset. So,
now, why would you suppose, and I'm sure I've asked you this in other episodes where we've talked about this, why would anybody espouse doing a systematic withdrawal where you just, cut off what you need for income, sell some stock or sell some bond, whichever is higher or whatever, and then rebalance? I still
because
can't
that's
see
what
a
we've been told
justification
for
for
decades. We've had modern portfolio theory since the 50s telling us that the diversification is the key to your long-term return, and we've had balanced portfolios ever since. I mean, that was the popular in the 90s when Mr. Benjamin, I think he's Dr. Benjamin actually, put out the 4% rule, and all these. So we've been indoctrinated into this balanced portfolio idea since day one. That's target date funds are a form of balanced portfolio that changes its balance as you get older, just out of the sheer fact that you got older, not having anything to do with your actual needs or looking at what's happening in the market or trying to avoid what may be happening in the market on a negative side. And so I don't like target date funds if you didn't get that through that little piece there. Although you can use them at times. But anyway, it's just a matter of we have been hit over the head so many times about diversification. And asset allocation is most important. But all of that deals with accumulating wealth, not with distributing wealth. It's a different game. Mm-hmm. Book after book after book, I don't know how many books, thousands, maybe millions, I don't know, have been written about creating net worth. Very few ever address the idea realistically of how to turn that net worth into a distributable event that you can count on going forward and avoid the problems. Because what was an advantage, market volatility and time, we don't have time anymore for some of the money, and market volatility is a killer. So,
well, and this comes back to the quote that I said a moment ago, Morgan Housel, there are a million ways to get wealthy. That's how many books there are, but there's only one way to stay wealthy, some combination of frugality and paranoia. So the idea of separating your income needs from your growth assets means, of course, like a bucket one type of setup where you've carved off a piece. Let's use that where we need to. For income, we can maybe do some value averaging, as we've talked about in other episodes, but that's kind of the basic thing. Now, you touched on this other one. The second one I wanted to bring up, besides separating your income needs from your growth assets, which is avoid reacting emotionally to market volatility. Now, you just covered that very, very well. As you said, when markets fall, the worst move is to panic and sell, even if you're not selling to create an income stream.
Unfortunately, people do it all the time. They let the markets dictate their buy-sell strategy when that's the wrong thing to do. The markets are not your friends. They're not your friend. They will go against you at the wrong time for any number of reasons. And so you want to be able to take that specific area out of the equation. Take that ability to screw you over out of your world, because it's just one of those things. Not everybody believes in Murphy's Law. I happen to. Whatever can go wrong will go wrong at the worst possible time. And we have to take that kind of a thing out of it. I know that I deal with certain types of products and certain types of investments. And I look at what is the worst that could happen in this kind of an investment. And if the worst case scenario is a reasonable fit for what I'm trying to accomplish, then I'm okay with that particular investment. But if I have to, bank on that company outperforming, doing all kinds of wonderful things to give me a reasonable rate of return, I'm not going to go with that kind of an investment, because it doesn't work that way. Make it work with bad news, and then know that when bad news happens, it's not going to hurt you.
Yeah, it's about preparing for the bad things that
That's
could happen.
The pessimist side of that quote from Mr. Housel earlier.
Yeah, that's true. He was the one who said invest. What was it? Save like a pessimist, invest like an optimist. I think that's
the one you said earlier. The two things that you need to do.
The two. Yeah. Well, that too. Yes. Yeah. Some combination of frugality and paranoia. Well,
paranoia. Okay, I'm sorry. I said the wrong P word.
No, it's okay. That's fine. But the idea is still the same. And having a strategy, I think, as long as you stick with it, can help, I believe, remove some of that emotional response.
And having a strategy that works only in the best of times is not a strategy. Having a plan, you know that the plan's going to change, and it's not always the market that changes it. It's us that change it. I mean, our goals change. And I talk about this for people going into retirement. They have an idea of what retirement's going to be, but they've never been retired, so they don't know for sure what retirement's going to look like until they learn how to be retired, and then you have a better idea. So you have to have the flexibility to enjoy life, to accept what life gives us, and you have to have a plan to take away the risks that we know are going to happen. We just don't necessarily know when they're going to happen.
Yeah, somebody said, I'm paraphrasing, but they said life is just one bleeping thing after another, and it's a series of bad things one after the other. But when you back it up, it all adds up to something positive. So it can be hard to see those things. And you're right about the plan. We've said before on this show that if you have a plan that requires this will work perfectly, but we need these 15 things to
fall in line.
They have to fall in line, and you will be just bonkers with money.
Well, that's like saying the lottery is a great thing for that one person that wins it. I mean, but what about the 20 billion people that buy the ticket that didn't work for?
All you got to do is pick the correct numbers. I mean, it's just whatever.
It's so easy.
It's so easy. So these are the things. So these two things that we've mentioned so far, and separate your income needs from your growth assets. That should help you to keep from losing. The other one is avoid reacting emotionally to market volatility. A third one that I think is a good idea if you're trying to keep from losing, if you're trying to not lose, play defense. I would add, don't chase returns. Follow the plan. When you jump into this, there's a hot sector, and there's always a hot sector somewhere, even in a bear market. When they try to pull out of underperformers and jump into these winners, to me, it almost always ends badly.
Yeah, jumping from sector to sector is a hope, and it might work, but it's a little sketchy at times because what we think is going to happen doesn't always happen. There's so many unknowns that we can't account for every variable. And even if we can look at a lot of variables, there's variables we don't even know that are going to be variables in the decision next week, next month, the following year. There's something that's going to come up that nobody ever thought of before. I mean, going back decades now, but that tsunami that wiped out the Fukushima reactor in Japan that sent the market down for a little bit. I don't think anybody had that on their radar, at least not until the day before.
Well, no, you are absolutely correct, and you're following exactly where I was going with this. When we look back at all the things that were really changing to the markets, let's say, the things that mattered a lot. I mean, we can just go back, 30, 35 years or 25, 30 years. Well, the .com, bubble and bust. Well, who saw that coming? Well, I mean,
everybody, but we just didn't know when. We saw it coming years before it actually happened, and people made a lot of money up until it didn't.
But let's say in 1989, that's not something that anybody even knew about because they didn't know anything about an internet. What is a .com? It hadn't existed yet. But these are the things that they couldn't prepare for. You had 9/11. Never thought about that happening. We had the housing bubble, which in hindsight should have been blatantly obvious. But to most people, it was like, maybe this is okay. You had the pandemic, and then, history is full of these things, and there are things that people absolutely couldn't predict. The quote, which I was going to bring up in a little while, which has to do with unexpected events, was that a Stanford professor, Scott Sagan, and I saw this quote, it was really good, says, "Things that have never happened before happen all the time." And
I like that.
Yeah,
I agree
exactly.
with it too. I mean, maybe that's why I like it.
Yeah, but relating this to the whole idea of don't chase returns, jumping into the hot sector. I mean, we saw it's not hot forever, and you have to know when to get out. This gets into the whole market timing thing, and I don't know anybody who successfully timed the market over a long period of over 4, 5, 6 years ever.
I have not found anybody, and the actual statistics go against that. And I know that some people have made books and made their name on predicting certain downfalls, like they did in the 2000 and some earlier ones, the 87 crash. But when you look back at their history, they're always predicting a downturn. So at some point, they were right.
Well, that's true. I don't know. Now, you meet with people who are they're somewhat financially savvy, maybe just because they've been hanging out with you or whatever. But a lot of do people ever ask you when you're talking to, say, clients, or you're talking to people across the desk about, gee, should I jump into this or jump into that? Does that come up very often in your meetings, or does that not?
It comes up often enough, and it also depends on what's actually happening. Like, as we're recording this now, gold has been on a terror this year. It's up significantly. And so people are like, have I missed the boat, or is now a good time to get in? So the question is, either one of two. Have I missed out on it, or can I get into it and have it go up more? We see this with things like Bitcoin. We see this with gold. We see with sectors of AI, other things like that go on a terror. And like, I know when the top of that run is going to happen. By the way, I don't. I don't know when it's going to happen. And I don't know what the next sector that's going to just jump up is going to be. But yeah, we get those questions quite often. The more broad-based question is, okay, the markets are at all-time highs. Is now a good time to be in the market, or should I get out of the market completely?
And here we go again.
It's either all or nothing for these people.
Right. And it's short-term thinking. How can I make money? I should be making money on this over the next 6 months or year. And it doesn't matter what the fad is or what the hot sector is. I want to make money now. And it always comes back to bite you, I do believe. All right. So don't chase returns. That's something that I think should be obvious, but isn't always. Here's one that we talked about many times, and I'm going to throw this in here. A fourth way to keep from losing is to respect what we call sequence of returns risk. Again, losses early in retirement in your portfolio can devastate your long-term outlook, even if it all averages out just fine over 20 years.
Now, I'm going to change the way you've said that. Mm-hmm. Losses in my growth portfolio early on, assuming I do not sell them to create cash for my spending, I'm not worried about that. Mm-hmm. Losses early on, or I'm selling to maintain a specific income stream, cash flow stream, that's where we come into trouble.
Yeah.
When we have to or want to and end up selling something that's down. Now, if my portfolio, I'm using the old systematic 60-40 portfolio, and it's up every month for the next 10 years, I'm probably okay. By that time, if I haven't experienced a downturn, even if I have a downturn in year 12, 13, whatever, it's probably not going to affect me too much. But if I have that downturn in year 2, 4, 6, or even the odd years, it's going to have a problem with my long-term viability. And how much of a problem? Well, how much of a downturn? How many downturns? One big downturn is going to have a problem. Several smaller downturns are going to have a problem. But it's all about what happens in the first 5 to 10 years of my distribution strategy, not the growth portfolio. Because in the distribution strategy that we're going to deal with through buckets and things of that nature, we have growth assets. We're just not relying on them for cash flow. We built in a time horizon for them to recover, so that we are never in a position where we're selling something when it's down to create current cash flow or to satisfy our emotional fear factor.
Well, and what you just said goes back to the first 2 points that we made, which was separate your growth assets from your income assets. Don't combine them, and then keep the emotion out of it. And if I'm going to relate this back, this is what bucket 1 is designed to do. It's actually designed to do both of those things. Keep your growth assets away from your income assets. And people tend to be less emotional, we've found, when they have some form of income coming in that's not related, that is not dependent upon or correlated to the volatile stock market. And
right. I mean, if you're basing all your cash flow on the market, you are going to be much more emotional about those downturns. That's just the way it is. Well,
it would be scary if I thought, well, gee, I'm going to need this money in the next year, and look at this. It's it's down 20% or whatever it is this year. So when we talk about sequence of returns risk, and we've talked about it many times, we don't have to rehash what that is. If you want to know, you can check out our other episodes on this. Wasn't too long ago, I think, when we talked about that. But just you have to understand that the way to avoid that whole you cannot retire and know when the markets are going to go on a downturn. They could go on a 10-year dead spin.
We saw that in 2000, where if you had invested at the top or in the beginning of 2000, it took about 10 years to recover based on the index. Now, it took a little less than that if you were reinvesting and doing the right things and not selling. But a lot of people were selling in 2000, 2001, 2002. Yeah, they were just.
And they had that whole 10 year. We didn't even. We not only had the 2000 to 2002 downturn, but then we had the 2007 to 2009 downturn.
Just as we were starting to feel better.
Just when we got another bubble going, look what happened. We went from the .com bubble of the late 90s, learned our lesson there. Oh, but look at this, mortgages at 1.25%.
But I wasn't buying things that didn't have earnings. I was buying real estate that didn't have earnings.
That's right. Those .coms that didn't have any earnings. Well, okay, I should have known that. But look at this real estate.
I can get a 90%, 95% leveraged loan that I have to fund out of pocket even when it's rented. But I can cover it because it's going to grow at 20% a year.
It's
it
funny.
did for a little while, until it didn't.
Yeah. And it's funny because, we've seen these lessons for the last 100 or more years in finance with money. People seem to make the exact same mistakes over. They don't learn from, we should have learned in the 90s what the bubble thing was. And here we were 6-7 years later going through the same thing. That goes to the whole idea of cyclical knowledge versus cumulative knowledge. And that's a topic for another show. But yes, people tend to make the same mistakes with money. So the last thing on here, after sequence of returns risk, the four we've talked about: separate your income needs from your growth assets. That should be obvious, especially if you know about buckets. Avoid reacting emotionally. That can keep you from losing. Don't chase returns. Be sure you do that. Respect sequence of returns risk. And then, as we just kind of talked about a moment ago, expect the unexpected would be the last thing that I think you should do. Health issues, you got family emergencies, inflation, market crash, whatever it is. It's not just about having some kind of, I'm not talking about having cash reserve on the side for emergencies, okay? That's still a good thing to have. But as I said before, things that have never happened before happen all the time. This is where I think the whole idea of having room for error comes in.
Well, you never know what's going to be on this horizon. You're flowing into uncharted territories. We know that the markets react certain ways. They go up and they go down. Why they go down is not the same reason every time. Why they go up is not the same reason every time. It's usually something that we hadn't thought about before as the reason it came down. Just like we were talking about the dot-coms and then the real estate. They went down for different reasons. It went down nevertheless. So there's lots of things. And we knew that, then before the dot-com bust, I mean, come on, Greenspan was talking about the exact irrational exuberance in 96, but it kept going for 3 years. So we could see certain things coming. We just didn't know when. Other things we didn't see coming. I mean, the one in 2008, we saw that one coming too. I mean, when you can be making $30,000, $40,000 a year and qualify for an $800,000 loan on a condo in Las Vegas at the MGM Grand, there's a problem with that loan. I mean, that is a high risk, but it was being sold as A paper to the investors. So these things, the vision was there. But most people just chose not to see it.
Yeah.
But then there's also the things we just can't see that just come out of the left field, that black swan event.
Does it make you wonder what things are happening right now?
Oh, there's stuff out there we haven't heard about yet.
In front of our eyes, though, where in 10 years or 15 years, we're going to look back and say, how obvious was that? How obvious? How did we miss that? In 2025, people were blind to this, as they were for the most part during the dot-com bubble, as they were for the most part during the housing bubble.
Well, I'm actually recording separately. I shouldn't be telling you this because I'm keeping them secret. How could you have thought about investing in this? How could you have thought about all these different sectors so that if they ever go down, I can bring those back out and say, look, I recorded this in 2025. I knew about it then. I'm a genius. But the ones that don't work out, I just won't publish those.
You just delete those. Yeah, you'll be people will be turning to you for all kinds of advice, And then when you're wrong,
about the time I want to retire, I don't want to talk to you.
I'm done. I'm through with you. Very quickly, because we're about out of time. But the whole point of us bringing this up, the best way to win is to keep from losing. That quote. This kind of wraps around the bucket strategy, obviously, because we like to talk about that. But it's true. I think this is why the bucket strategy, as it is, the way that you practice it, Professor Plum.
Buckets, capital T, capital H, capital E, the bucket strategy.
Well, that's what it is. Because if you look online, you can find somebody who's going, there's a 3-year bucket. That's a bucket strategy, a 3-year safety. That's not it. But the bucket strategy, as you practice it, is designed to deal with all 5 of these things that we just brought up.
Oh, yes. It's all designed about not spending something when it's down, avoiding sequence of return, managing your emotions. All those things are part of the plan because I mentioned it many times, but when I first got into financial planning, how many decades ago, I thought having a degree in finance, economics, accounting that was you got to have that kind of a mindset. The longer I've been in this industry, yes, those are very important. But having a psychology degree would sure help because people do some really crazy things, and it's hard to understand. And everybody has a different relationship with money, and it was born with them, and it was drilled into them growing up. And you have to understand that relationship to understand how you're going to react to certain things. And that, in many respects, is more important than, telling somebody you need to have 7 years worth of cash. Mm-hmm. Now, we've got to get to the root of some people's problems, which is why they continually do things that are detrimental to their financial health. I'm not going to try to help you with the health because I do enough bad things to myself. I haven't figured that one out from that side, but the financial health side I can help with.
Well, you do eat pretty well. I'll give you that.
This office is dangerous for that.
I know it is.
They brought in lunch the other day. There were so many pizzas. I was like, how many people are we feeding?
Well, you understand it's an Italian family there that's,
and food is their social life.
You better believe it.
Thank
You
God.
better have enough. You cannot run out of food. That is a cardinal sin. If you want to know more about the financial part of this, not necessarily the food part, but the financial part, talk to any of the Lucia Capital Group advisors. 800-644-1150. 800-644-1150. You can talk to Professor Plum as well. Rick is the Chief Financial Planning Officer, so he oversees all of these plans. And they all work together. They work as a team. And you know that if you're going to be talking about the bucket strategy, this is exactly what I'm talking about. This is how they devise it. And to win, I don't want to say that because there's no guarantees, obviously, but to potentially win, or to keep from losing, let's look at it that way, you need to have the bucket strategy. That's all there is to it. 800-644-1150. You can go online, find out more of this stuff, luciacap.com, LUCIACAP.com. Learn all about it. Download our guides. We have a bucket strategy guide. We have I've been telling you this many times, we have an estate planning guide, Social Security guide. We have a retirement guide. All that stuff, just type it into whatever you're looking for. Type it into the search bar in the upper right-hand corner, and you can download these PDF files absolutely free. And we're going to be putting a few more up there as well over the next probably 6 to 8 months. So be looking for that. Subscribe to this podcast. Absolutely. Got to do that. I should have said that first. Go to Apple Podcasts or Spotify and download it. We always love seeing new subscribers. If you're new to this, please send us an email. We'd love to see it. You can send us an email through the luciacap.com website. Happy to do that. Thank you, Professor Rick Plum. I'll let you get back. Or maybe it's lunchtime. I don't know.
Yeah. We still had leftover pizza for lunch.
Okay. All right. Well, then.
I already had my share.
Okay. Well, I'll leave you to that. My thanks to you. For Professor Rick Plum, certified financial planner, professional, and accredited wealth management advisor, I am your podcast host, Johnny Dean. This has been Managing Your Financial Future. Thanks so much for listening. We will talk to you all again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. All performance referenced is historical and has no guarantee of future results. All indices are unmanaged and may not be invested into directly. An asset allocation strategy does not ensure a profit or protect against loss. Stock investing includes risks, including fluctuating prices and loss of principal. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. Bonds are subject to market and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise. Bonds are subject to availability, change in price, call features, and credit risk. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Target date funds are subject to the volatility of the financial markets, including equity and fixed income investments in the U.S. and abroad, and may be subject to risks associated with investing in high-yield, small-cap, and commodity-related foreign securities. Principal invested is not guaranteed at any time, including at or after target dates. Before investing, carefully consider a target date fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. A value averaging strategy does not guarantee a profit or protection from loss. The investor sets a target growth rate or amount on his or her asset base or portfolio each month and then adjusts the next month's contribution according to the relative gain or shortfall made on the original asset base. Since such an investment plan involves continual investment in securities, you must consider your willingness to continue purchasing during periods of high or low price levels. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. Any other individual or company mentioned in this podcast are not affiliated with or endorsed by Lucia Capital Group or LPL Financial.